My name is Abdul Adamu. This is a continuation of our lecture on corporate finance. In this lecture, we are going to look at bonds and valuation of bonds. Now, in the lecture, we are going to try to understand what bond is, how bonds are valued, and some of the function of rating agencies in credit rating bonds to classify them either investment grade bond or junk bond. So by introduction, a bond represents a long-term financial obligation of an entity. It is a debt investment in which an investor loans funds to the entity who borrows the fund for a defined period at variable or fixed interest rate. So for bond, sometimes the interest rate could be fixed or sometimes it could be variable. Now, the person borrowing the money will have a commitment to pay a specified amount of money periodically. The specified amount is what we call the coupon or the interest of the bond. And at the end of the stipulated period, depending on the type of bond you are dealing with, he will also have the commitment to repay the money he borrowed, which is the principal, at a stipulated time in the future. So bonds generally are issued by government, or they are also issued by a corporation. So especially those looking for long-term capital. Now, bonds has so many characteristics. We'll look at few of them. And the first characteristic of bond is face value or the par value, or it's also called the maturity value. So these are mostly payments made when the bond matured. So, and it is normally in thousands of naira or dollars and multiple of 10 thereafter. Then the other characteristic is the coupon payment. Coupon payment or the interest payment. This is paid to the bondholder periodically. So, and it is set at the time they are issuing the bond. You understand? So this always to induce people to invest in the bond. So also we have maturity. Maturity is normally the period the bond issuer will have to repay the face value of the bond. Then we have redemption value. That is the value that those holding the bond will get at the end at maturity, and it could be three types. It could be at par, that is at the face value. Then it could be at premium, that is it will be higher than the face value, and it could be at discount, that is lower than the face value. So then the one characteristic also is the market value, that is the bond price, the price at which the bond is selling currently, which we are going to look at under the valuation of bond. Then we also have call provision. Some corporation they issue bond which can be callable before maturity. So if those provisions are there, then the issuer has the right to call the bond before it reaches maturity. So the issuer must pay an amount that is greater than the face value when they are calling the bond. This is called call premium. So other characteristics are sinking fund. Normally, the firm that are issuing bond are required to have a sinking fund, so that, and this sinking fund should be with a trustee, so that those that invested, there will be a fund accumulated to settle them when the bond matures. Then bond also could be a convertible bond, that is the holder will have the option to convert it to common stock at fixed price. Also a characteristic warrants, that is bond issued with warrants are like convertible, but instead of giving the investor an option to exchange the bond for stock, warrant gives them an option to buy stock at a stated price, so thereby providing capital gain if the stock price appreciates. So we can also have a putable bond. It allows investor to require the company to pay in advance. If the interest rate rise, investor will put the bond back to the company and take the money and invest in higher coupon bond. Then it will be also an income bond. Those that pay interest only if the issuer earn enough money to pay interest. That's if they make profit. Then it will be index or purchasing power bond. So the interest, this one, the interest rate based on the inflation, such as the CPI. So the interest paid rises automatically when the inflation rate rises, thus protecting the serving as a hedge against inflation. Then we have different types of bonds. Among them are we have a government bond or sovereign bond. So bond issued by government like the FGN, Federal Government of Nigerian bond. We have corporate bonds. Corporate bonds are bonds issued by a corporation to raise finance for a variety of reasons. We could also have agency bond, that is bond issued by government sponsored agency like the power, that is water board, transport or water agency, power, that is power holding company can issue bond, although it's a private company. Now if it's government agency, they can issue bond, or like railway can issue bond. So we can also have supranational bond, national bond. Supranational bond are issued by institution formed by two or more central government. Example, the World Bank or African Development Bank can issue bond. Then we have subnational bond, that is other levels of government can also issue bond. Other arms of government like local government, state government, bond issued by them for building schools and roads are called subnational bond. Then we can have euro bond. Euro bonds are issued in currencies other than the domestic currency of the issuing entity. For instance, if Dangote, which is based in Nigeria, issue bond in pound, so it's an euro bond, or in dollar, it's an euro bond. So saying euro bond does not mean bond issued in euro, but rather bond issued in other currency. Then we have short-term bonds. This is a phenomenon introduced by FMDQ recently. So they are debt security issued by a non-sovereign entity whose tenure, the period, are 1 year and not exceeding 3 years. Then we have sukuk bond, like those that are concerned about faith. So this take care of issue of interest. So like they are called Sharia compliant bonds, structured to comply with Islamic law, which prohibit payment of interest on borrowed amount. Then we have green or climate bonds. Bonds earmarked to be used for climate and environmental projects. So these ones are linked normally to support climate related activities to encourage sustainability. Then we have diaspora bonds. These are bonds like government sell bonds to investors abroad. That is, they are citizens that are living in diaspora. So they buy this bond to help develop their country as a result of patriotism. So those are some background about bond, these characteristics and types. So we go to bond valuation. Now, for whenever we talked about valuation or value of an asset of an investment, we are looking at the market value or the price we can put on that asset. So a security value is normally the present value of returns you are expecting from that security. So for a bond, the expected returns from a bond are normally the coupon, that is the interest you are going to be getting, the investor will be getting, and the face value or what they'll get at maturity, which is the maturity value. So here we are going to consider three types of bonds. We are going to look at redeemable bond or bond that has a maturity date. We look at zero coupon bond, Then we also look at perpetual bond. Now, first, for redeemable bond issued for a specified period are what we term redeemable bond. So this bond, first, they have two types of stream of payment that comes from them. One is the coupon, the frequent coupon that are paid, periodic coupon that are paid, or periodic interest. And then at the end of the period, the coupon is also paid along with the maturity value. So basically the cash flow from these bonds are the interest payment and the maturity value. Now, if you look at our number line here, this is a bond that paid 40 naira coupon for 1, 2, 3, 4, 5, 6 years. So you can see the $40, 40 naira for 6 years. Then at the end of the sixth period, the $1,000 the 1,000 naira that was used to buy the bond will be returned. So to get the value of this bond at this period, then you have to find the present value of this stream of payment. If you look at the first stream of payment, 40, 40, 40 for 6 years, this is in the form of an annuity. If you go back to our definition of an annuity, and there is 1,000 in 6 years, this is a lump sum. So if we discount it backward, that is the present value of a lump sum. So we do this discounting and we add them together. So if we take that into cognizance, then the coupon is 40%, which is an annuity. The principal is 1,000, which is a lump sum. So that means the value of a bond, of a redeemable bond, is present value of the coupon, which is an annuity, plus the present value of the maturity value, which is a lump sum. So the present, if you recall our formula for present value of an annuity, the annuity is the interest or coupon payment, in this case, which is $40, 40 naira. Then the value at the end is the 1,000 naira, which is the maturity value. So to find the present value of an annuity, if you recall, this is our formula, and present value of a lump sum, this is our formula. So if you bring the two together, the value of bond will be the addition of these two factors. So if the discount rate or the cost of debt, KDA stands for cost of debt, that the investor will earn with similar investment. So this is the formula. This is the formula for finding the value of a redeemable bond. So let's take an example and see. So if, for example, a company issued an 8% 10-year bond with a par value of 1,000. If the required rate of return is 9%, how much is the market value of this bond? Now you can see we have two rates. The first rate is to enable us compute the first year is to enable us compute the coupon. We call it the coupon rate. So we use it to compute the interest. Then why this is the required rate of return, or the yield to maturity. So the interest will be this 8% multiplied by the par value. So when we multiply, we have 80 naira. So the cost of debt is 9%. Then the face value is 1,000 and the period is 10 years. So if we put it into our formula, the first part, which is present value of an annuity, the second part is the present value of a lump sum, which is 1,000. So this is the factor from this formula. This is the factor from this formula. When we multiply, we have 935 naira 82 kobo. So this implies that this bond is worth 935 naira 82 kobo. So we can not pay anything more than this for this bond today, given this rate of return. But if we see if the price for the bond is below this amount, then we are buying it at a premium to better. But anything above it, then it means the value, the bond is overvalued. So the investor will not be willing to pay more than this for the bond today. Note that this is a composite value for the present value of an annuity and the present value of a lump sum. So this question can be solved using the table. If you go and you are using the table, you get those factors from the table. You can see these factors are from the table. This one is from the present value of an annuity. Look at the factor here, and this is the present value of a lump sum. When you multiply them, we have the same answer. You can use financial calculator. If you take your financial calculator, if you remember our calculator, this is our calculator. So let me cancel it. So let's see whether we can use our calculator. So from the question, we see our PMT is 80. So the calculator 80, that is our PMT. Then our N is 10. This is our N. Our rate is 9%. 9, that is our percent. Our future value is 1000. 1, 2, 3. Future value. Then we'll calculate the present value. So we say compute present value. So we can see 935 naira 82 kobo, and that is correct. It is showing negative because if you are buying today, it is an outflow. So then using Excel, let's go to our Excel. If we are using Excel, we see a company 8% bond with a par value. So the 10 years face value is 1000. The coupon rate is 8%, and the required rate of return is 9%. First, we'll calculate the interest, which is equals to this times 8%. Enter. That is the 80 naira. Then we'll go here. We'll use our present value formula equals to PV tab. Our rate is 9%. That is the required rate of return, not the coupon rate, comma. Our period is 10, comma. Our PMT is 80, comma. Our future value is 1000. That is all. We press enter. So that is the 935 naira 82 kobo. Now note that in this Excel, whenever I'm doing computation, the color is this is blue or green. So this color that I use here, I don't know color like that, but that is the color. Anywhere you see this color, it means we made computation there. So this is how we find that. So that is how we can find that using our Excel. Now, the one important thing sometimes that we need to find is what we call the yield to maturity. So the yield to maturity, if you look at our formula, the required rate of return is the yield that the investor is earning. So that is what they will earn until the bond matured. So the speculative rate of return or interest rate of a fixed rate security is the yield to maturity. So notice that the two interests are associated with bond pricing. The first is the coupon rate, which I have explained other, and is used to determine the size of the interest payment to the bondholder. Now the second is the cost of debt, which is the retired rate of return. That is what the market is giving on comparative bond at the time the price is calculated. So don't confuse these two. The rate at which the present value of cash flow is taken is KD. The only thing we do with coupon rate is to calculate interest payment. The return or yield on bonds investment is KD, and it is the interest rate that makes the present value of all payment equals to the bond price. So because it considers all payment until bond matured, it is called yield to maturity. That is the required rate of return. So the yield to maturity is what people refer to when we talked about the bond yield. So to calculate the bond yield, if you know the current price and you know the face value, so you can use the rate function in our Excel. So to find the yield to maturity, all you need to do is to find the YTM. You solve for it. So this can be done using the rate function in Excel or financial calculator. It is easy. But if you don't have this, then you have to resort to trial and error. You can use trial and error to find it. So I demonstrated how we can use the trial and error. Then I will use the Excel and the financial calculator to see how we can solve this. So let's take this question. Suppose you were offered 14-year 10% annual coupon. This is a coupon rate, not our yield to maturity. So the par value is 1,000. This is the current price. What is the rate you will earn on this if you held it to maturity? Don't forget, you held it to maturity, you'll be given par value. So if you put this in the formula, the price today is 1493.93, like that is the one here. Then the face value is 1,000. So the only thing we don't have here is the required rate of return or the yield to maturity. So this can be solved using trial and error. So what you do, will just assume a percent first, since this is 10%. So let's and 10%, and we say the value is 1,000. So let's take a percent lower than it first. So let's assume 4%. If we assume 4%, the objective is to get a value that is higher than the price now and a value that is lower than it. Then we do interpolation. So first we try 4%. When we try 4% as YTM, the bond price is 1633. You can see this is higher than the price we are looking for, 1494.93. Then we will see later the relationship between this rate and bond price. So once the price is high, you want to reduce it, you increase the rate. So we increase the rate by 6%. We have 1371.80. So if you look at this, this is higher than what we require and this is lower than what we require. So we interpolate. You arrange it this way. This is the one required. This is the one at 4%. This is the one at 6%. So the difference between this and this minus this, we get this. That is the difference between this and this. Then this minus this, we get this. That's how we got these two numbers. That's how we got the two numbers. So to interpolate our YTM, we start from the lowest rate, which is 4%, plus the difference between these two rates, since the rate we are looking for is between them. So that is 6 minus 4, that is 2%. That is, then we multiply by this, the one on top divided by the one below, whatever the value is, this divided by this. So when we multiply and we multiply this by 2%, we add this, we have approximately 5%. So let's go to our Excel and see how we can use. First, let's use our calculator. So let me cancel first. We are looking for rate. So first, our present value is 1494.93. So negative 14. Let me cancel it again. Minus, cancel again, 1494.93 negative. That is our present value. Then our present value, our n is 14. Our face value is 1,000. Our interest is 100. So let me go back to my calculator. Our N 14, that is N. Our PMT is 1000. No, face value is 1000. Our PMT is 100. 100. That is PMT. We compute the rate. So you can see the rate is 5%. The rate is 5% with calculator. Now with Excel, yield to maturity. So this is the question. Current is this. Period is 14. Coupon is this. First, the interest is equals to the coupon rate multiplied by the face value. That is 100. Our ITM, I said we use the rate function. Rate. Our period is this, comma. Our PMT 100, comma. Our present value is this, comma. Our future value is this. Enter. This is 5%. So that is the rate. That is 5%. So this is how we use Excel and financial calculator to do the computation. Now the next thing we'll look at is current yield. So current yield is normally the yield you are receiving now. So it is the annual interest divided by the interest divided by the bond current price. So if you look at our question, you see that the interest we are earning now on this bond is 100 and the current price is 1494.93. So if we divide 100 by that, we have our current yield. So let's look at it. So if we divide it 6.7%, we can go to our Excel to confirm that current yield. This is the interest now is 100. This is the current price. So the current yield is equals to the interest divided by this. Enter. So 7% is minus because the current price is minus. So we can make it minus. So which is 7%. Let's see. That is 6.69% current yield. So we go back, that is 6.7%. So we can adjust it 6.7% to decimal place. So then the other type of yield is yield to call. Since we define bond that bond can be callable before maturity. So once bond is callable before maturity, then what are the yield up to the point of calling the bond? So the yield to maturity will not be earned if it's called before maturity. So yield to call is the rate of return earned on a bond when it is called before maturity date. So when you want to compute it, all you do, you replace the YTM in our formula with yield to call. So the N will not be maturity, rather it will be the year the bond is called. So assuming you purchase a bond 15 years par value days, so you can see the maturity is 15 years. So this is the current price, that is this BO. Its annual coupon payment is 75, that is the interest. Assuming this bond is callable 7 years, this is our N. Now we use this 7 instead of the 15 in our formula. So, and this is the call price, that is the call price here. So what is the yield to call? So if we use our formula, we are getting 5.81. So but let's go to our Excel and see the yield to call. This is yield to call. Now the yield to call, this is the formula, this is the current price, this is the period, this is the call period, this is the call price, this is the fee. So yield to call, we are going to use our rate formula still. So the period, we are going to use 7, call period. Then the PMT 75, comma, the present value is this price, comma, future value, face value is going to be the call price. The call price, then enter. So 5.81%. This confirm the computation we are seeing here. We can use our calculator too. So that is that. So let's, in the real life situation, the coupon are normally earned on a semi-annual basis. So majority are semi-annually. To evaluate semi, we must modify our formula. So first, you will divide the interest by 2. We divide the rate by 2. The way we modify formula for compounding more than once in a year. So if that is what you do, you can see we divide our required rate of return by 2, multiply our period by 2. So these are what we do: divide the coupon rate by 2, multiply the year by 2, divide the nominal rate also by 2. So then if, for example, a 10-year 1000 bond has a rate of 12% semi-annually, what is the bond price if the required rate of return is 16%? So you can see the coupon 12% times 1000 is 120. We divide it by 2 to have 60, or you use 6% times 2. Then the period is 10 years, semi-annual is 10 times 2, that is 20, and our interest of 60% by 8. So once you put it in a formula using table, you have 803 naira 53 kobo. Now if we go to Excel, this can be demonstrated in our Excel. You can see the period is 10 years, the is semi-annual, that is why it's 2. So the number of period will be equals to the 2 times the 10. Enter, that is the 20. Then the coupon rate, periodic coupon rate, this will be equals to the coupon rate divided by 2, divided by the 2 is up, that is the M. We have 6%. The interest will be the face value times the 6%, that is 60. The periodic rate will be equals to the rate divided by M, that is period, number of period, that is 2, that is the 8%. So the current price, we use our present value, the rate, that is the periodic rate, comma, the period is this, comma, the PMT is 60, comma, the face value is this, enter. So 803.64 kobo, 803.59 kobo. That is we approximated here. That is why. So that is the answer. So now the next thing we'll look at is the second type of bond, which is the zero coupon bond. So from the name zero coupon, this means that this bond do not pay coupon. So they do not carry explicit rate of interest. They provide for lump sum payment in the future in exchange for current price. This kind of bonds are normally issued at discount. That is, the price you pay for it is lower than the face value. So the return is the difference between the face value and the purchase price. So it is also called pure discount bond or deep discount bond or zero interest bond. So to do the calculation, all you do is you take the present value of the face value. The present value of the face value, if you remember, this is our formula. So example, an investor is looking to purchase a zero coupon bond with a face value of 1,000 and 5 years to maturity. If the Required rate of return is 5% compounded annually. What price will you pay? Very simple. You take the present value of 1000 at 5%. So you have 783.3. So we will pay 783 naira 53 kobo. We can use the present value formula in our Excel. So we'll go to Excel. That is zero coupon bond. So these are the information: 5 years, 1000. So equals to present value rate 5%, comma, period is the next one, comma, payment, there is no payment, another comma, future value is the 1000, enter. So 783 naira 50 kobo, 53 kobo. This confirms the answer that we have. Now we can find the yield to maturity for this by making the R, this KD, which is our yield to maturity, the subject of the formula. So if we make it the subject of the formula, we can get the yield to maturity using this, the nth root of face value divided by the bond price minus 1. So if we have this example, what is the yield to maturity of semi-annual zero coupon bond with a face value of this that is selling for this? So the BO is this, which is down here. So 1000 divided by this, you have 1.20. You take the 10th root, which is 1.025. Then you subtract 1. You have 0.025, which is 25%. So the rate function in Excel can also be used. Let's go back there and see zero coupon bond yield to maturity. So you can see this is the price here. Then the period is semi-annual. Semi-annual, that is why we have 5. We have 2 here. That means the period is equals to 2 times 5. Enter. We have 10. The rate now, if we use the rate function, we have rate. The period is this, comma. The payment is zero coupon, another comma. The present value is this, comma, and the face value is 1000. Now, the 2.5 is the semi-annual rate every 6 months. If you want to have yield to maturity, all we do, we multiply this times the number of period, which is the 2, enter. So we multiply 2.5. Let me come again, equals to this times this. So which is 5%. That is the 5%. So that is how we get yield to maturity. You can use the rate function to get this value. So the next thing is the perpetual bond, or what we call console. This, from the name you can see they have no maturity value. So for no maturity value, they have indefinite life. So this bond pay only interest for life. So these days they are not really found, but they were used in England in the olden days. To calculate, we simply discount the interest backward. So they use the perpetuity formula, interest, discount it using the required rate of return. For example, the value of 12%, 10,000 bond will pay forever if the interest rate is 15%. So 12 times this to get the interest, that's 120. So this divided by this, you get 800. 800 naira is this. So we also demonstrated it in Excel, but not with any particular formula. All we do is we calculate the interest. The interest is equals to this times the coupon rate, 120, then this is equals to the interest divided by the rate. Enter, which is 800 naira. So that is the value there. Now the next thing we'll look at is the relationship between bond value and interest rate. If we see that whenever the bond market or going rate of this is equal to the coupon rate, a fixed rate bond will sell at par. So when the coupon rate 8% is the coupon rate and the required rate of return is 8%, it will sell at par. So normally the coupon rate is set at the going rate in the market the day the bond is issued, causing it to sell at par initially. The coupon rate remains fixed after that is issued, but interest rate in the market move up and down. So how does this interest rate affect the value of the bond? So if you look at the table here, you see that when the required rate of return is 3%, the bond price is 1,426 naira 51 kobo. When it is 5%, 1,231. You can see as the discount rate increases, the price decreases. So that means there is an inverse relationship between bond price and interest rate. You can see clearly from the graph here. As the rate increases, the bond price decreases. So let's go to our Excel and demonstrate this using a particular question. You can see a company issue 8% bond with a par value of 1,000. The required rate of return is 9%. How much is the current price? No, we want to use it to demonstrate the relationship. So let's find the interest first, equals to this times the coupon rate. So that gives us 80. So let's see at 5%, what is the bond price? Equals to present value rate. Our rate is this 5, comma, our period end par is 10. So let's lock it, F4 to lock it, since I'm going to copy it down, comma, our PMT is 80. We're also locking it, F4 to lock it, comma, our face value is 1,000. We're also locking it, F4 to lock it. So the only thing we didn't lock here is the percent here, because we are going to be using this percent downward. So you can see we have up to 50%. Now let's enter. This is the value. So let's make it positive. So give it minus from the formula. Now this is the value. So let me double click and move it down. So if we double click and move it down, you can see the value clearly from 5% to 50%. So you can see the value at 5%, the bond price is 1,231.65 kobo. At 10% is 877 naira 11 kobo. So you can see as the discount rate or the required rate of return increases, RRR, as it increases, the bond price decreases. So if you look at 5% is 1,231, at 50% is $174.57. So this is the graph here. This is the graph showing the relationship. You can see clearly the graph is coming down like this. As the rate increases, the price decreases. So that is the relationship. So let's continue with our lecture. So now summarily the relationship is such that if the required rate of return is equals to coupon rate, it will sell at par. Let's go back to our listing. What is our coupon rate here? Our coupon rate is 8%. At 8%, we can see the bond is 1,000. which is our par value or the face value. That is correct. Then secondly, if the required rate of return is greater than the coupon rate, it will sell below par. So if it's greater, the coupon rate is 8%. Greater means 9, 10, 11. You can see it is lower than this. Then that is correct. If it is less than coupon rate, then it will sell at premium. So 5, 6, 7, they are less, so you can see they are greater than this. That is the premium. So that is correct. So it can be concluded that an increase in interest rate will cause the price of outstanding bond to fall, while a decrease in interest rate will cause the bond price to rise. This is very, very important to understanding the relationship. So let's look at the riskiness of a bond. So we have three types of risk. We have different types of risk with bond. First is the price risk. So the price risk, interest rate fluctuate over time, like we showed earlier, and when they rise, the value of bond decline. The risk of a decline in bond value due to increase in interest rate is what we call the price risk or interest rate risk. Reinvestment risk. An increase in interest rate hurts bondholder because it leads to a decline in the current value of the bond portfolio. But can a decrease in interest rate also hurt bondholder? The answer is still yes, because if interest rate fall, long-term investor will suffer a reduction in income. The risk of an income decline due to a drop in interest rate is what we call reinvestment risk. Default risk. Potential default is another important risk that bondholder will. If the issuer default, investor will receive less than the promised return. So bond rating, the another aspect that we'll look at is rating of bonds. So bond rating are representation of bonds of the creditworthiness of corporate or government bond. The rating are published by credit ratings agency and provide evaluation of a bond issuer's financial strength and capacity to repay the bond's principal and interest according to the contract. The major rating agencies we have, there are three. I think there are three. We have Moody Investor Services, we have Standard and Poor S&P, and we have Fitch Investor Service. The AAA and AA bond are extremely safe. We are going to look at we have their rating. So if it's rated AAA, then they are safe, or AA they are safe. Single A and triple B bond are also strong enough to be called investment grade bond, and they are the lowest rated bond that many banks and other institutions are permitted by law to hold. Double B and lower bond are speculative or junk bond, and they have a significant probability of default. So determinant of bond rating, we have a financial ratio, that is ratio you compute from finances of this firm. We have qualitative factor like the contract terms and other things. Then we have miscellaneous qualitative factors, so like issue of inflation and a whole lot of things. So these are the S&P rating. You can see AAA means it's extremely strong, the investment grade. AA, BBB, all these are investment grade. The other one are speculative grade. So you can see AA means very strong capacity to meet obligation. But look at B, more vulnerable to adverse business, financial, economic condition, but currently has the capacity to meet financial commitment. So let's look at that of Moody. So Moody use A and small a. So the first four are speculative grade. Almost the same thing with the S&P rating. So in Nigeria, we have some rating agency. Some of the rating agencies we have, which their rating criteria is just more or less like that of S&P and Moody, are Augusto and Co. and Data Pro Limited and Global Credit Rating. So GCR. So this brings us to the end of the lecture. I believe I have added a little value. So thanks for watching and listening.